Hi guys, it's Zhang again from Moolahwise.com, and today I'm just going to be answering a question that we get all the time, which is comparing a 529 college savings plan versus an index universal life, or what we like to call an IUL. Although there are some differences, but there are also some similarities. So let's get into it. Again, this video is for entertainment and educational purposes, and everyone's situation is different. So please consult with your financial professional before you implement any of these strategies that I'm sharing, because it may not be for you, and everybody's financial situation is different. So please, this is more for a conceptual training, and whatever you do with your family finances, please consult with a professional. So let's get into it. So I've mentioned these three buckets of taxes before in my previous episode, but it bears repeating again. So in the USA, there's really only three buckets of taxes. Okay, so the first bucket is what we call tax now. The second bucket is what we call tax later or tax deferred. This third bucket is called tax advantage, or sometimes people have used the word tax free. So in the first bucket, tax now, accounts like savings account, checking account, mutual funds, stocks, cash deposit, real estate. Basically, whatever gains you have in this account gets you have to pay Uncle Sam or pay taxes every single year. And as these amounts get bigger, the amount that you pay to Uncle Sam also gets bigger. It's depicted by this graph. So each one of these lines represents years, and every year you have the account, you have to pay taxes to Uncle Sam every single year. The second bucket is what we call tax later. Think of this bucket as like your retirement accounts. So accounts like your individual retirement account or your IRA, your SEP IRA, or your 401k or your 403b, your pension, your annuity. The way this bucket works is that all the money saved in here is that you won't pay taxes on any of the gains now, but you will pay taxes on the year you take it out. So what I always ask my client is, Mr. Client, do you know what your tax rate is going to be in the future? And they always tell me, no, I don't. And the reason why I ask that question is because if you don't know what your tax rate is going to be in the future, then doesn't it make sense for you to pay taxes when you know the rate? So it's depicted by this graph right here. So I think I like to think of this as like a temporary tax deduction. So in the early years, when you put it in, you don't pay any taxes because these accounts are funded with after-tax dollars. So that means that the gains in here are going to be taxed later when you do touch the money. And then the last bucket is called the tax advantage or the tax-free bucket. In this bucket, the money grows tax deferred and tax-free, depending on what vehicle you're using. So it's depicted by this graph. So you pay the taxes up front. Like I was saying, you pay the taxes when you know the rate. And then every year that it grows, you don't pay anything after that. So think of this as paying taxes on the seed, and this is paying taxes on the harvest. So my last question is, where are you currently saving your money? Because it's either in the first bucket where you get taxed every single year on your gains, and when your amounts get bigger, the amount that you pay to Uncle Sam also gets bigger. Or is it in the tax later bucket where you don't pay any taxes right now in these years, but the year you take it out or the year you need it the most in retirement, you will pay more taxes. You will pay taxes on it. So think of this as the Uncle Sam gets his taxes with interest back. And in this bucket, you pay taxes today, but then after that, in the future, all the growth is tax-free. So I want to ask yourself, where are you currently saving your money? So again, so today we're just comparing the 529 and the cash value life insurance, or IUL. There's many types of cash value life insurance, and the type we're specifically talking about is index universal life, or what we like to call IUL. Again, so the similarity is that both saving vehicles are in the tax-free or tax advantage accounts or tax bucket. But what they can use for is different. So let's get into that. So in the 529 college savings plans, you fund the account with after-tax money. So what that means is it's in the tax advantage account. So that means that anything that grows in here grows tax-free until you use it. And in our case, since it's a college plan, we want to use it for college. So a couple of the downside of that is that the stocks inside of a 529 plan could go up or down. So meaning if your portfolio or your 529 is made up of all stocks, and if the stock market corrects itself, then let's say the year you needed the money, what if the stocks inside your 529 is at 50% value? Then your 200,000 is actually at 100,000. Right. And there's also tax-free withdrawal if you use it for school. But if you don't use it for school, you lose 10% penalty. And guess what? A lot of people don't know this, but 529 actually counts as an asset, and it will count against you it will count against you in terms of financial aid. So the way that rule works is the college or the FAFSA calculates how much the school is going to cost, how much you guys or your parent have an asset, and then what is that difference that your family has to make up. And in the 529, it counts as an asset, so they will count it as an asset. So they will go towards the asset side column of your financial aid calculation. But let's see what some of the features are for the IUL. So again, it's similar in the 529 where it's self-funded with after-tax money. So that means that you've already paid the taxes on that money, and so any growth is tax-free if you follow the rules. In this case, it's tax-free if you use it for college, but on this side, since it is inside of a cash value life insurance, you could save money in here, and there's no taxes. Some of the benefits of this is that there's downside protection and there's upside potential. So meaning downside protection, I'll make another video in explaining that further, but basically downside protection means that if the market goes below a certain percentage, like 0, your money or your cash value will not go negative. But the flip side of that is that the insurance company has to pay for that downside protection somehow, so they cap you off with the upside. So let's say if the market is going up 20-30%, you will get up to the cap, and then after that the insurance company gets to keep it. But I think of it as a fair trade because they're protecting your money from losses, so they should be able to recoup some of their losses on the flip side, right? And there's tax-free withdrawal for any reason because it is life insurance. As long as you satisfy the insurance rules, then it is a tax-free withdrawal, no tax consequences. And one thing that a lot of people don't know is that when you save money inside of an insurance and you go to apply for financial aid, it doesn't count as an asset. So that's one thing that I like to tell my clients. So I'm a numbers guy. I like to see what kind of numbers and see how the tax affects it. So let's look at some numbers and compare it. So on the left side, we still have the 529 college savings plan. At age 18, let's say you've been saving money for your kid to go to college, but he decided he doesn't want to go to college. At age 18, he wants to buy a house, right? He wants $200,000 for a house, right? So he could take it out from his 529 plan, but since he's not using it for college, he'll lose 10% penalty, right? So after 200,000 minus 10% taxes, which is 20,000. So 200 minus 20,000 will give you 180,000 net after taxes. And then on the IUL side, at age 18, again, same example. Let's say this kid doesn't want to go to college, right? And he wants to buy a house. And he has $200,000 in his cash value or his savings component of his cash value life insurance. So he could take out the $200,000 for a down payment for a house. And since it is inside of an insurance policy, there's no taxes on the money. And you can use it for whatever reason you want. As long as you have enough cash value to take it out, you could take it out. And even in some cases, if you don't, you could take it out. You can still take it out too. But terms and conditions may apply to those situations. So again, 0% of 0 is still 0. So you get 200,000 net after taxes. So I always ask myself, what side would you rather have? The side where you lose 10% just because you're not using it for school, or the side that you don't lose 10% regardless of what you pull it out for. So again, this is only designed for a conceptual training and conceptual understanding. Please do not take this as financial advice or financial please consult with your financial professional with your situation, because everyone's financial situation is different. And I can only speak for my family, but so yes, please consult with your financial professional before implementing any of these strategies, and talk through everything about the pros and the cons. So yeah, if you have any further questions, please reach out to me at moolahwise.com, or schedule a time to sit down with us so we could talk more about your financial plan. Again, this is just for conceptual training, and I don't know what your situation is until we sit down and talk. All right. Thanks, everybody. I'll see you on the next episode.